Hi, I'm Scott Starratt with Starratt Wealth Management, a part of Canaccord Genuity Wealth Management. So we're partway through the summer now, and as I'm taping this in the beginning of August, um, I would say that there's one word that has become the word of the summer, and that word is resilience. And I'm going to describe resilience in two current ways, as well as looking back to some statistics that I found quite interesting from the past. The first way that it currently is being measured or is being used is in the Canadian economy. And although the Canadian economy has weakened quite a bit, we're really not to the point yet where we would say that the Canadian economy is in a recession. Now, it might be going forward. We do have a lot of weakness, especially in certain sectors like aluminum and steel, which still enjoy a 50% tariff rate. Interesting that, according to the Globe and Mail, about 65% of goods that are sold into the US currently fall under the USMCA, so the old free trade or NAFTA agreement. So, or the new, I should say, free trade NAFTA agreement. And that, for the most part, they aren't getting hit with any tariffs at all. And there's an estimation by the Globe and Mail as well that that number could get higher than 90% if the paperwork is filled out by some companies that currently were exposed or are exposed to these tariffs. So, like I said, it seems to be certain sectors of the economy that are being hit more than others. And the government has indicated that they are supportive of providing some help to those particular companies and those industries. The US as well has been quite resilient as it applies to its economy. When you look at the fact that employment, continues to be very, very strong, unemployment very slow. Most people would say that they're pretty close to full employment still. And although some of the data in the last month has indicated that there is starting to be some weakness, we really haven't seen a whole bunch of weakness. The consumer appears to be continuing to spend in the US, and since 70% of the GDP in the US comes from the consumer, then you would indicate that the consumer is the most important part of that whole equation. The second part of resilience is in the markets. We continue to see stock markets going higher and higher as more and more tariffs hit, as more and more drama occurs south of the border, and as more and more countries throughout the world struggle to deal with the U.S. administration and their economic policy as it relates to them. And so, surprisingly, we continue to have a lot of ups and downs day by day, but for the most part, markets are trending higher, and they have been for the last few months. And so, although we don't expect that to necessarily continue in a straight line going forward, the resilience that it has shown is quite surprising. More on that in a second. The final piece of resilience is the Fraser Institute last month in July 2025 came out with an interesting set of statistics. So they went back to 1961, so quite a few years ago, obviously, and to take a look at how much things have changed as far as inflation and costs and things like that. And what I found interesting was that clothing has gone up about 460% since then. So a big increase, but we are talking about a great number of years. The inflation rate, as measured by the CPI, is up 925%. So that would be your standard inflation rate that many things like pensions and our financial plans and stuff are used based on. Food has gone up 927%, so essentially the same as what inflation has. And then we get to the big increases. And again, this is for Canada. According to the Fraser Institute, shelter between 1961 and today is up 2,129%, significantly above the 925% that inflation is up. At the same time, consumer tax index, so this is a measure of how much Canadians are being taxed, is up a whopping 2,784%. So, taxes have increased significantly. Well, what's that? Almost triple. what the consumer price index is up, and definitely taking more and more of a bite off of all of our paychecks or our remittances that we have to send to the government whenever we make money in our investments. So all that to say that consumers have continued to be very resilient in Canada as they continue to spend, even though taxes are going up and their dollar definitely is not going as far as it used to, even up to a few years ago. And so what we expect to happen is the unexpected. And I know that maybe is a cop out, but the reality is nobody knows what the impact of tariffs or some of the decisions that are being made throughout the world, really, but let's say primarily in the U.S. is going to be. The Canada still has to come to an agreement, or hopefully will come to an agreement of some sort with the U.S. And I say agreement really in quotation marks because all the agreements that have been talked about in the media are really nothing more than handshake deals. My understanding is, according to the Financial Times, is that really there hasn't really been any significant legal papers drawn up on any of these agreements. So I think we're in a position now where the details will come out eventually. Now, the thing about trade agreements is sometimes it could take a decade for a trade agreement to be fully enacted. But we'll see what happens. I think President Trump is more focused on making announcements and winning the PR battle than he is about winning the legal battle as it applies to many of these things. The interesting part will be now that they are starting to collect as of well, not now, but in a couple of days, as of August 9th, they will start collecting on a whole bunch of these dollar figures that they've announced, is what the effect is going to be on the economy and on the markets, and whether the resilience that we have experienced since Liberation Day in beginning of April will continue on going forward. Our portfolios continue to be balanced. We continue to model out whether we should add more money to the market at this point, which is probably less of a thought, and whether we should be taking money off the table at this point, even though we have been quite conservative going into the summer. But our models do indicate that we do have cash available and that we can take advantage of opportunities if those opportunities present themselves. And we just want to be able to avoid what we would call a melt up in the market. So a melt up, my definition of a melt up, is when markets go so high that it becomes unrealistic for companies to continue to grow at such a high rate. In other words, that they look at increasing their prices of the stocks a lot faster than what their growth of the core business or profit is doing. And so when we look at that, if we do hit a a melt up scenario, that we do want to make sure that we do maybe take some money off the table and get more defensive. I don't think we're there yet. I mean, again, the unknown is the unknown, but I don't think we're there yet. But definitely it is something that we're watching. As we wind down August, if there are any questions that anybody does have or want to chat about the markets, financial plans, or any other issues that you find important, please do reach out to Jim, myself, Angela, or Alex. And other than that, we'll look at getting together with everyone as we approach the fall and answering any, like I said, questions that you might have.